Hey there fellow traders and investors, welcome back to my channel where we make the complex world of finance simple and exciting. Today we have a fascinating topic to discuss, option Greeks. Now I know that you are thinking, what on earth is option Greeks? Well, don't worry, by the end of this video you'll be able to understand option Greeks in detail and you'll improve at understanding the powerful tool. To help you understand option Greeks better, we'll be using Nifty index as an example. Nifty is a widely followed stock market index in India, representing the top 50 companies listed on the National Stock Exchange. It's a great reference point to explain how option Greek works in real life scenarios. So let's dive right in and start unrailing behind the option Greeks. The first Greek we'll explore is delta. Delta measures the sensitivity of the option price to the change in underlying prices. It tells how much the option price will move for every 1 point change in the Nifty index. Think of it as a direction indicator. Imagine you holding a call option on a Nifty with a delta 0.7. This means that if the Nifty increases by 100 points, the price of the call option will increase by 70 points. Here's how delta works. The range delta range from 0 to 1 for call option and 0 to -1 for put option. A delta of 0.5 means that your option price will move half much as your underlying asset price. A delta of 1 means your option price will move in a perfect correlationship with the underlying asset. It's important to note that delta is not fixed. It can change based on various factors such as time of expiry, change in volatility, and shift in underlying asset prices. Now let's meet gamma, the acceleration factor. Gamma measures how much delta changes when the underlying asset's price changes. It's a crucial Greek because it shows how fast your profit or loss can accumulate. So let's say your call option on Nifty has a gamma of 0.04. If the Nifty index is increased by 100 points, the delta of that option will increase by 0.04. Gamma helps you assess the potential risks and reward of your option positions based on market movement. Remember, higher gamma means that your option delta can change more rapidly, leading to potential larger profits or losses. It's essential to keep an eye on the gamma and monitor how it moves along with the market condition. So coming on to the next option Greek, people usually tell time is money, and Theta tell us that how much money we can lose or gain due to the passage of time. Theta measures the change in price of option with each passing day, also known as the time decay. Let's imagine you are holding a call option on a Nifty with a theta of -0.5. This means that for each passing days, the option price will decrease by 0.5 points. So if everything else remains constant, the option becomes less valuable as time goes by. Now let's understand why theta is important. Well, it highlights the concept of time working against you as an option holder. Options with higher theta loses more value rapidly as the day passes. This means that if the market doesn't move in your favor within a short time frame, the option value can decline significantly. Managing theta is essential in option trading, especially option buying. You need to consider the time decay factor when choosing your option strategies and determining the optimal entry and exit point. Last but not least, we have Vega, the Greek associated with volatility. Vega means the change in price of option by every 1% change in implied volatility. Let's suppose a call option on Nifty has a Vega of 0.08. If the implied volatility increases by 1%, the option price will increase by 0.8 points. Implied volatility represents the market expectations of the future price fluctuations. When there's a high volatility, option tends to be more expensive, and when there is low volatility, option tends to be cheaper. So Vega simplifies the relationship between the option price and the change in implied volatility. It tells us how much option price will change for every 1% change in implied volatility. So there you have it, my friends. We have explored the key option Greeks: delta, gamma, theta, and Vega. Remember, understanding this Greeks will give you a deeper insights into how option behaves under different market conditions. I hope you found this video informative. Now, armed with this knowledge, you can make more informed decisions when trading option, whether it's Nifty, Bank Nifty, or any other financial instruments. If you enjoyed this video, give it a thumbs up and subscribe to my channel for more such exciting content like this.